Appraisers matter now more than ever. Yes, things are changing. Tech is disrupting. Lending is happening much faster. But we still play a large role in the world of mortgage finance. Appraisers matter now more than ever. Stick around and find out why.
Don't believe the fiction that no one's liable for inaccurate information provided in a property data collection. Property data collectors must certify that the information provided factually represents the property characteristics. For hybrid appraisals, the appraiser isn't liable for property data collector, just like they wouldn't be liable for using a typical third-party data as part of their assessment. The mortgage lender remains responsible for verifying the accuracy of the property description and the completeness of the data. Get the facts at fanniemae.com/propertydata.
You're listening to the Appraisal Buzzcast with your host, Hal Humphreys.
Welcome back to today's Appraisal Buzzcast. I'm Jim Morrison and joined again by our host, Hal Humphreys. Let me bring him back in. Hey, Hal, how are you doing?
Jim, I'm doing great. How are you today?
I'm doing really good. Well, we're really excited today to talk with Simon Blackburn, the CEO of MtgeFi. Simon recently gave a presentation at the Appraisal Summit on why appraisers are still a key part of the mortgage industry. And even as technology is growing, their work connects local properties to national and global financial markets. Let me bring in Simon. How you doing, Simon?
Yeah, nice to see you this morning.
Simon, it's very good to see you. Thank you for taking the time to be with us. I got to say, I loved your presentation at Appraisal Summit. I enjoyed getting to meet you while we were out there at Appraisal Summit. During this time of the real estate appraisal world, there is a lot of doom and gloom out there. And just the title of your presentation was uplifting. And the presentation itself really shed some light on the role that we appraisers play in the broader world of mortgage finance. And I think it's important that appraisers understand these things. So thank you for taking the time to be with us. Before we dive into our conversation, do me a favor and just kind of introduce Simon Blackburn to our listeners. Tell us how you got into this crazy space and how you became familiar with the real estate appraisal world.
Yeah, happy to. Well, MtgeFi, I'll just say a bit about the company's data analytics and advisory firm specializing in mortgage and housing finance. Me personally, I've worked with mortgage lenders for a couple of decades, primarily on back-end systems, actually. And then more recently, several years ago, I worked on a consulting project with a national valuation company and eventually joined them. And part of my experience there was helping lenders with appraisal modernization on a pretty large scale. A diverse set of lenders. Some of them were very successful and some of them were less so. So that's kind of the background to the experience I think is kind of relevant to the presentation at Appraisal Summit and perhaps a discussion today.
Okay, good. We appraisers tend to think of our work as being local work. We talk a lot about geographic competency in the appraisal world. There's this notion that, you need to know your market and be familiar with your market. Don't get outside of your lane kind of business. But part of your presentation talked about the broader implications of the work we do as appraisers. And that's one of the parts that really kind of thrilled me is getting to look at what it all means. How do we appraisers connect to the broader picture of mortgage finance, mortgage-backed securities, those kind of things?
Yeah, no, it's a great question. I don't know if I said it in the presentation, but one way I kind of think of it is that as an appraiser doing appraising in a GSE world, which in the US it really is, right? You kind of have a tiger by the tail because, the whole securitize and agency securitization model has ended up, it's a charter for supporting affordable housing, but it's ended up being this massive asset class, global fixed income. It's huge. And, out there, It's traded something. I think there were some stats in there. It's traded like $300 billion per day, average daily trading. I mean, that's up there with all of equities. And a lot of it is backed by mortgage loans that were, had their risk assessed, collateral assessed with an appraisal. So, out there today, it's a critical asset class used by governments, pension funds, insurance companies. And, it's a result of this securitization, GSE securitization and Ginnie Mae securitization framework that was put in decades ago in the US. And really, very few other countries have something like it.
Yeah, so when we do an appraisal, say it's for a regional bank that we
Mhm.
think we're working straight for the bank, walk me through just kind of generally, you don't have to go into real great detail, but walk me through what happens with that appraisal report. And I know so I want to be clear, like the real estate appraisal portion of risk analysis is a part of the risk analysis. You've got the credit side of risk, you've got the collateral side of risk, and value is a part of the collateral side of the risk. But what happens with that loan and that appraisal after the appraiser is done with it?
Well, I think, well, two things I would say. One is that you may not know, but you may be doing an appraisal for a loan that is intended to be sold to one of the agencies. But if it's intended for a bank to hold on to portfolio, they may have increased levels of scrutiny that they put on that appraisal, overlays, they sometimes call them, on top of, on the loan, on the appraisal. So what happens? I mean, it is the appraisal is submitted. I think people know this, obviously, to UCDP, which and that is a automated collateral risk scoring mechanism, right, for both the GSEs and whether banks intend to sell that to one of the GSEs or retain it. They generally do submit it through there. So that is just that's step one
Mhm.
of this automated assessment of the appraisal itself and the collateral, and then banks are obligated, any lender's obligated to review that appraisal, along with other things, right? Of course, and before they, and so, and satisfy themselves that it's an acceptable property, acceptable loan before they sell it or retain it.
So this example is along the lines of the first house I bought years ago, and I bought the house. I borrowed the money from a local bank, from a hometown bank, and part of the collateral process was to get an appraisal. Part of the credit side was the banker knew me and said, "Hal, I'm not loaning you any money unless your dad signs on the note with you."
No kidding.
Um, but they were holding on to that note internally, and they were going to deal with the risk internally. And they serviced the loan. Like I would send my check once a month to the local bank with a little check stub that I would send in. What happens if the bank is planning on selling it up to Fannie or Freddie or any of the GSEs? What happens at that point with the GSEs, and what do they do with that mortgage, number one? But how does the appraisal kind of work its way through that process?
Well, you hit on a great point, I think, because a bank, ultimately a bank is an investor, right? They're going to retain that loan. But they also want to have the flexibility at some point to sell it to another bank, to another investor, actually to deliver it to sell it to the agencies. They want to have that ability. If you haven't underwritten the loan according to the selling guides, whether it's Freddie or Fannie or one of the other, there's lots and lots of investors. If you haven't underwritten it to those standards, then you can't sell that loan. So it's super important, this standardization. But what happens is, I mean, it's delivered into the GSE systems through UCDP. They score it, they approve it, or they don't approve it. There may be things to cure on there. There may be requests that come back either from the lender or also from the GSE. So it's just one of the documents that is, essential for loan closing. And of course, as lenders know, it can come back years later as well. So, so you want to know why people, do automated quality control checks, have people, collateral reviewers. I mean, they're looking and they're trying to, they are trying to minimize the risk associated with that loan in general, the collateral, and the repurchase risk coming back to them.
Yeah, yeah. So it is a critical part of the process.
LIA Administrators and Insurance Services, serving valuation professionals since 1978. We provide E&O insurance with a commitment to superior customer service, outstanding liability education, and unmatched claim defense. Explore our exclusive appraiser liability education by Peter Christensen and cost-effective seminars designed to foster your growth. Our underwriters, with an average of 26 years of experience each, are dedicated to supporting appraisers. Visit liability.com to discover how LIA can safeguard your business.
At Summit, you talked about the trading volume. You just mentioned the massive numbers revolving around trading volume for mortgage-backed securities, those kind of things. Talk to me about the role of appraisers in kind of facilitating that. And can you tell us what that all means? Just kind of boil it down to what does this trading volume mean in the global scale of things?
Yeah, I would say the way that it sort of resonates with me is if the way securitization works is it's such massive volumes of loan originations and so loans being serviced, 50 odd million or something, first mortgages. I think the role, so in the securitization world, it's all about standardization and the fact that you have to deliver a loan and an appraisal that fits into their box. And once it does, it gets delivered into a pool and it gets secured, and priced and securitized, and people are purchasing those securities, those bonds, out there in the marketplace. And to put it in perspective, I mean, right now it's probably 400,000 to 500,000 loans per month, right? Going through that process. At the height in 2021, it was well over a million a month. So you can see, and then if you go to the other side, the private label security side, which is the non-agency, non-QM world, I mean, there's 25,000 a month, and each one of those loans and the collateral is inspected, is re-underwritten and looked at. So you can kind of see why, so when appraisers are asking themselves, why are all these changes coming? Why UAD? Probably why the 1004 before? It's because they are, there's so much automation in the quality control and due diligence process just because of the sheer scale of what is going on. That's kind of the way I think about, well, why is this happening? Why do they need to do this? And of course, it's not just appraisal, it's all the asset income, employment verification, tax and flood. Every single thing is automated just for those sheer scale reasons, I think.
Yeah, and I think the interesting thing, the reason I want to kind of dive into that a little bit is the interesting thing is there aren't just local implications for the work we do. At this point, we're talking about global implications. You've got investors from around the world that are buying these tranches of loans as an investment package.
Yeah, yeah. No, absolutely. So I think it is the appraisal is the gold standard, right? I mean, that's what's backing, that's what's assessing the risk on the collateral that's out there today. And so, you know, being an appraiser and understanding the local markets and what that means to the value of the property and doing that accurately is important. Even, one loan at a time, because every single loan is in that pool is being securitized, and they're relying on the remittances, the payments from the borrowers. They're relying on that. That's what's pricing the security.
Yeah. And the other thing that I think is really interesting to consider, and I'm painting with a pretty broad brush here, Simon, but we're talking about global impacts for lenders and those kind of things. But all of these things have to do with our local bank's ability to continue to loan money. If they hold on to too many loans themselves, they deplete their capital,
Yep.
and therefore they can't function. So the GSEs provide liquidity. The investors provide liquidity for the banks to continue functioning. And I think for appraisers, I think it's really important for us to understand that we play a part in a very large system that relies on our work.
Yeah, that's a great way of putting it. The liquidity, when you deliver an appraisal, not and especially if it's securitized, you're not only enabling that loan, you're enabling a lot more because they are, the capital's coming back. I think banks do play a huge role, but they're going to continue to play an important role. There's a lot of borrowers, there's a lot of properties, there's a lot of loan amounts that just do not fit into the credit box of the agencies. I mean, GSEs are only, I think if you add up Freddie, Fannie, and Ginnie, it's still only two-thirds of the loans being originated today. A third of it is banks and to some extent credit unions.
Yeah, yeah,
So their standards are agency plus. They have the
yeah.
minimum they have to meet, and then they have overlays, because the loan amounts are larger, typically banks, and things like that they're going to look at.
Yeah, so there's a lot of changes happening out there in the world. We've got tech has advanced and is changing constantly. To my mind, sometimes at a pace that is kind of terrifying because I'm a bit of a Luddite, but I get that tech changes. We've got AVMs. We've also got the GSEs looking at waivers and those kind of things. How should appraisers think about the tech side and the waiver side of things in terms of our importance in the world?
Yeah, I think well, if one of the things I always bring up, and the GSEs tell me this too, is hey, no appraisal on file, no waiver. Right. So just when you think about that for a minute, you're like, okay. I mean, it's a black box, it's proprietary information, proprietary models and what they do and how they change it over time. I couldn't comment on, but I think it's really important that they have, when they offer a waiver, an appraisal waiver or an inspection-based waiver that just requires one of these property data collections. I mean, they're doing that on properties and borrowers that they are very confident about.
Yeah.
And by the way, every single one of those loans that's in the securities, it tells the investors what the property valuation type or method was: appraisal, inspection-based waiver. They can see, and they are modeling prepayments, the prepayment speeds on these bonds, the performance of these bonds, essentially. I mean, they're monitoring them and they have access to all that information on a loan level every month. So,
And if the
when you worry about the risk and I mean, the investors and the GSEs are obviously looking at this and have been for years at this kind of tranche of loans that they consider lower risk and they offer waivers on.
And just kind of, again, broad brush thinking, are there investors out there that really do want to see an appraisal attached, or that would be less interested in a tranche of appraisals that were all waiver based and more interested in a tranche of appraisal or a tranche of loans that were appraisal based?
I mean, someone's going to probably tell me I'm wrong. The only two entities I know that offer appraisal waivers are Freddie and Fannie.
Yeah.
Oh, I guess you could say Ginnie Mae and VA, FHA streamlined refinances.
Yeah.
But I don't know of private investors that do that really. So I think it's always going to be, on a scale, right? It's going to be limited to people who have a lot of data and a lot of history and a lot of confidence about what they're doing from a waiver perspective. And it's much heavier in refinance, right?
Yeah.
Obviously, than it
Yeah.
ever is in purchase.
Yeah, absolutely. That makes total
So,
sense. From the appraiser's perspective, I mean, again, we started off, I talked about there's a lot of doom and gloom out there. The GSEs are trying to get rid of us. I don't think that's true. I don't think they can function without the data that we provide. But are there opportunities in this emerging system of hybrid appraisals, direct lender work, those kind of things? Are there some opportunities that you see for appraisers out there?
yeah, I mean, and again, I'm not commenting on whether I'm not really commenting on the hybrids and the inspection-based waivers and the changes. I'm just saying, here's what's in the selling guide. How do you take advantage of it? whether you approve of it or not. So I would say a couple of things. First of all, if I was an appraiser, I would say to my local bank or my customers directly, hey, I can complete hybrid appraisals for you. And you can. So that's, not going through an AMC. You can be on an appraisal panel and you can complete hybrid appraisals directly today. So I don't think a lot of people really realize that. I don't think it's been well publicized. And I think, genuinely because there's a lot of changes being implemented, and that's been based with lenders and AMCs and other kind of valuation providers. Just actually getting it implemented and getting it working has been a huge, huge effort.
Yeah.
So that's number one. I think the other one is, and I do hear this, I find appraisers are very focused in on the property data collector, who that
Mhm.
person is, can they be relied upon, can the data be relied upon? And I think that sort of is missing a bit of the opportunity because I think if you're an appraiser yourself, you can do property data collections. You don't have to be doing it in the capacity of being a licensed appraiser. So it says it very clearly you can do it. Your trainees or other staff can do property data collection. Um, and I think the focus is always on who's the property data collector and what's the data for the appraisal I'm completing. Whereas I would look at it kind of the other way around and saying, hey, isn't it kind of fun to think that you can do property data collection in your area, in your territory, however you look at it, for all sorts of different appraisals, some of which may end up with, a colleague of yours doing an appraisal, but you can be doing a lot of business out there in the inspection world that is actually well paid for what it is, right? And you're actually providing that service and you can build that business. So that's the other thing. And I think, one thing I would say is that inspection companies generally employ um, real estate agents, home inspectors, insurance inspectors, notaries, appraiser trainees. I mean, they're not in the business of hiring people and training people as property data collectors who aren't going to be acceptable to a borrower or a lender. I mean, that's suicide, right? Why send someone who's not going to represent your company well and or do a really poor job? I mean, why would you ever do that? It doesn't make any sense whatsoever. And I think I kind of demoed it at Appraisal Summit, these 3D scans, complete capture of the property, dimensions, measurements, imagery, I mean, floor plans, everything. I mean, it's really a very effective method of doing those inspections. So I'd encourage appraisers to look at that, look at those opportunities, and you could be doing a lot more inspections than you ever were doing appraisals.
I think parsing the process that we appraisers are used to, which is get in an order, go inspect the property, come
Mhm.
home, do the report, do the evaluation, do the analysis, send it out, take credit for the entire thing. Parsing that out into property data collection, which is what we would used to
Yeah.
call an inspection, and we go out and look at a bunch of houses, and seeing that as a specific profit center,
Mhm.
the valuation portion being another specific profit center, opening the mind to allow that thought process, I think will reveal a lot of opportunities that people may be missing right now. And I would say, Simon, that people my age and older that are reticent to tie into seeing it that way, if they're not careful, there's a younger set that's coming into this business that will have zero problem doing that work.
Yeah, and I think that's a great way of saying it, by the way. Looking at them separately as profit centers, because that's essentially a good summary of what I was saying is, yeah, here's a business opportunity for you. And then I think, there's some choice here for appraisers, right? Because you can do that, or you can decide, hey, I want to focus on appraisals and I'm doing desktops and hybrids. I can do a lot more of them. The fees are healthy if you're directly engaging with lenders. And then you could have another staff member, or trainee, or you can just simply outsource the inspection. and get that information, by an fire inspection firm. So you got choices, but I think that direct engagement hybrid model plus being able to do property data collections, I think there's a business there for sure for especially early adopters.
Yeah, yeah, no doubt. I've got an older appraiser in Jackson, Tennessee, which is very
Mhm.
near my hometown, who has been doing hybrid appraisals for several years now, and he gets guff from his appraiser friends saying,
Oh
"How do
yeah.
you do that? Why, I don't know, you're such a low fee." He's like, "It's the best thing I've ever done business wise."
Yeah.
He can do so much more in so much less time. And as you said, considering the amount of work he's doing, the fees are pretty strong.
Yeah.
One last thing I want to ask you about, FIRREA has been around for quite some time. Um, why is FIRREA still important and how does it protect appraisers still today?
Well, I think, from the other presentations there, I think it was John. I think FIRREA is carved out for the GSEs, right? So I think, and I think, as he explained, the original intent of that was because they were operating to a higher level than FIRREA. I mean, in my opinion, they still are. I
Yeah.
mean, they will tell you that hybrid appraisals perform as well, if not better, than traditional appraisals. And that's not an emotional statement. It's kind of makes sense. The inspections are way, way more detailed, more data driven. There's a lot more captured through that would enable somebody, I think, to do at their desk a better, come up with a better job and have more time to do the analysis of comps and neighborhoods and all those sorts of things. So I think, I think FIRREA is relevant. I don't think it covers a lot of what happens today out there. But as private label securitization continues to grow, it's about several percent. I mean, FIRREA applies to that absolutely. So,
Yeah.
so I think I think the overriding theme when you look at all the things that have been going on, even things like PAVE, UAD, modernization, FIRREA, it's all, appraisers are the only persons allowed to do appraisals, period. That is it. And I think anything else where, even evaluations, okay, they can be used and are used for home equity, generally not used for first mortgages. I mean, because again, a bank at some point may want to sell that property, that loan, and if they didn't underwrite it to the GSE standards, they're gonna struggle to do that.
Yeah.
Scratch
Yeah.
and dent,
No.
they're gonna get paid less for it than they want to get paid for it if it wasn't underwritten in the way and originated and underwritten in the way that is the sort of de facto industry standard.
All of this, we're talking about things that fit neatly into boxes, loans that meet the parameters, appraisals that meet the standards, homes and properties that fit well into the form or the prescribed report format. There are a lot of properties out there in the world that do not fit neatly into any of these boxes, and they need to be appraised for the local bank or for investors. And I've been saying for years, appraisers, you shy away from the one-offs, you shy away from the difficult project. Those are the ones that are always going to be around.
Yeah, 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 and I do think that where there is a lot of property and properties that are sort of as people would say cookie cutter, there's an awful lot that aren't, and that's where you want a real estate appraiser, a professional trained valuation professional to go look at that property and the land and the neighborhood and everything else and make an assessment, come to their opinion of value for sure.
Yeah. Simon, thank you so much for taking the time to be with us today. I've enjoyed the chat. I hope we get to cross paths in the not too distant future. I enjoyed our chat at the Appraisal Summit. For our listeners, anytime you get a chance to hear Simon speak at an event, go. You will leave with a little bit more hope in your heart than maybe you've left events in the past. So Jim Morrison, our producer, usually comes at me and my guest with an anonymous appraiser question. Sometimes he lets us off the hook. Jim, are you going to hit us today or are you going to let us off the hook?
Hey, we're always looking for questions for our guests, but today we're going to let you off the hook, Simon. I know this is your first time on the Appraisal Buzzcast, so
Uh-oh.
we really appreciate you joining us. And if anybody has any questions for our future guests, reach out to us at comments@appraisalbuzz.com. Thanks, Simon.
Thank you, guys. Appreciate it.
Thank you, Simon. And if we have nothing else for Simon Blackburn and Jim Morrison, I'm Hal Humphreys, and that is your Appraisal Buzzcast for this week.